In this video, we're going to use the effective interest rate method to record bonds at amortized cost. Gamma Corp invested in a 3-year, 100 face value, 6% bond paying 105.55. At this price, the bond will yield a 4% return. Interest is paid annually. So we're going to prepare the bond amortization table. So when I do this, I set up a column for cash received, then one for interest income, one for our amortization, and then the carrying value. So the carrying value will be our bond investment. So in this case, our bond is our asset. And we have 3 years, so I'll just set them up like that. So I need to calculate the present value of the bond. They already did this for me. They said it was 105.55, but I'll just prove it to you that this present value is actually a premium. So we can use the formulas. So if you click on formula, then go to financial, and we'll scroll down until we find present value. It's right here. So the rate that we use is the yield rate or the market rate, and in this case it's 4%. The NPER is the number of payments. So since this bond pays annually and there's 3 years, the number of payments is 3. Now the payment is the interest payment that we are legally able to receive. So this is on the bond contract. So if you take the face value, which is 100, and then multiply that by the stated interest rate or the coupon rate, that's the 6%, that will give me $6. And the future value is the face value of the bond, and in this case it's 100. So I always put the payment and the future value in as positive, then it'll just spit out a negative present value just because of the time value of money. And we'll just leave the type empty. That's just to say whether or not the interest pays at the beginning or the year. So with bonds, it's always just at the end. Oh, sorry, I meant to say the beginning or the end. So with bonds, we're always paying the bond interest at the end. And then right here, it comes out as negative 105.55. And just so I can show this as a positive, I'll just switch this sign around. So that's my premium. Now, I already knew this was a premium before calculating it because when the stated rate, which is 6%, is higher than the coupon or the market rate, which is the yield, that means your bond is selling for more than the face value. Now, if those were reversed, then I'd be selling this bond for a discount. Now, in order to put my table together, I'm going to record the interest income at the yield rate, which is 4%. And the cash received is going to be my interest payments at the stated rate. So that's 100 times 6%. So that'll be the $6. And I'll just want to show everything to 2 decimal places here. So when I calculate my interest income, you'll take the last bond value and then multiply that by the market rate or the yield rate, which is 4%. So then of my $6, 4.22 is my interest income, and then the difference, so 6 minus 4.22, will be me putting it towards the bond investment. And since I'm trying to bring this carrying value from 105.55 down to 100, then I know I need to subtract this. Now this would be opposite if we're doing a bond discount, but in this case it's a bond premium. Now I'll run through the scenario again. So I'll take the 103.77 and then multiply that by the yield rate, which is 4%. Then take the difference, so your cash minus interest income, that means I'm putting 1.85 towards the bond. So then if I do 103.77 minus the 185, I get 101.92. And we'll do it one more time. So 101.92 times by the market rate, which is 4%. Now we'll take the 6 minus the 4.08 to get 1.92, and then subtract that from the 101.92 to give me 100. So I know that this table is correct because the face value has to equal the 100, just right here. I'll just highlight it. Okay, so now that we have our bond amortization table together, we can go ahead and do the journal entries. Now I'm going to keep this really easy. So I'm just going to assume that my bond payments line up with my year end. If not, we'll actually have to do interest accruals if my year end doesn't line up. So my first journal entry would be to debit the bond investment at amortized costs. Let's make sure all of that is lined up like that. There we go. And that will be for my 105.55. And then I'll do a credit to cash for 105.55. And this is to record purchase of investment. So that'll sit as an asset on our books. And now the second journal entry that I'll make is to record the first interest payment. So I'm going to debit cash for the $6. That's how much cash I receive. Then I'm going to credit interest income. And that's for the 4.22. And I'll also credit my bond investment at amortized cost for the 1.78. So you'll see that I debit the bond investment and then I make a credit for the principal portion or the amortization portion. And then my bond will be sitting at 103.77 on my books. So I'll just say to record interest income at end of year one. So I'm just because it's only 3 years, I'll just do all of my journal entries just so you can see what everything looks like for the life cycle of this bond. So my next interest payment, I'm just following my amortization table. So I've got the $6 of income that I receive for the bond. I'm allocating 4.15 to the interest and 1.85 to the bond. And that's at the end of year two. And now we'll do year three. And again, I'll record my cash that I received, allocate 4.08 to the interest, and then 1.92 to the amortization of the bond. And finally, when I'm ready to derecognize it, I'm going to debit my cash. So I'm going to receive 100, and then we'll credit the bond investment at amortized cost. So essentially, throughout this contract, we are receiving the market rate of 4%, even though contractually the bond is paying interest payments of 6%. So we can see that we paid more upfront and then received less at the end. And that's because this bond was sold to us at a premium.